Okay, we are recording. So we're on handout 14 and we're now on slide 20 of deck 6. And we've sort of promised to talk about intercorporate dividends and how intercorporate dividends are taxed, and that moment has now arrived. So here we go. On a basic level, the way intercorporate dividends work is really straightforward, right? You have a dividend inclusion for the corporation under paragraph 12.1J and 82.1A. No gross up though, right? Just a straight inclusion. And then the dividend recipient may deduct the full amount of the dividend received if it's a corporation and computing its income under subsection 112.1, provided that the requirements of subsection 112.1 are satisfied, and provided that none of the other provisions in section 112 that would deny the deduction of an intercorporate dividend apply in respect of that dividend. So we don't have things like term preferred shares or guaranteed shares or losses attributable to taxable dividends or any of that kind of stuff that would deny either deny a subsection 112.1 deduction or deny a loss where subsection 112.1 deduction has been claimed. So assuming that basically all of that stuff is beyond the scope of this course anyway, as long as the requirements of subsection 112.1 are met, then you probably get a deduction if you're a corporation that's receiving an intercorporate dividend. So what those requirements are, again, pretty straightforward, like you see on the slide. It requires only that the taxpayer be a corporation that has received a dividend in the year, and that the person from whom the dividend was received was either a taxable Canadian corporation, which is again defined in subsection 89.1, or that the corporation was not a taxable Canadian corporation, but was a corporation resident in Canada, subject to Part 1 income tax, and controlled by the dividend recipient. In most instances, though, the way to think about subsection 112.1 is that if the recipient is a corporation, the payer is a taxable Canadian corporation, you have a good subsection 112.1 deduction. So with that, we can look at problem 1 in handout 14 and starting with question A. So question A just asks, well, why do we not just exclude corporate dividends from income? Why do we just say, in our definition of income for a corporation, that income does not include a dividend from a taxable Canadian corporation if the recipient is a corporation? And there's no right answer to this question, right? I think the reason we've done this is that it's more difficult to enact an exclusion than it is to just have the income and the deduction offsetting like we do right now, given that any exclusion would have to be tempered in much the same way that we temper the subsection 112.1 deduction and we potentially turn it off in some instances. Seems to me that it's probably easier. This also keeps the tax base for individuals and corporations, at least on the gross income side of things, the same. And we just have a deduction from taxable income for intercorporate dividends received. So we do have ultimately a different tax base for corporations, but at least on a gross income level, we've kept it the same. So I think that's, in a nutshell, the rationale for doing that instead of just enacting an exclusion. Then the question turns to ask us, well, why is section 112 limited to taxable dividends? Right? Why not just any intercorporate dividend? And again, the rationale for this is basically the same rationale, the same answer to the question that we had with non-taxable dividends and the dividend tax credit, is that the subsection 112.1 deduction is supposed to zero out an income inclusion in respect of an intercorporate dividend. If there's a non-taxable dividend, then there's no income inclusion and there's just nothing to deduct, right? There's no income to zero out. So it makes sense that the dividend entitlement or sorry, the deduction entitlement should be limited to taxable dividends. And then finally, the problem asks, what must the status of the corporate payer be and why? And so again, this takes us back. This is a review of the very last slide we just talked about, slide 20. And the dividend payer has to either be a taxable Canadian corporation, or it has to be a corporation that is resident in Canada, not exempt from Part 1 tax, and controlled by the dividend recipient. So this definition of control generally refers to de jure control, although if you take a look at subsection 112.6, there's actually a slightly modified definition of control for the purposes of subsection 112.1. So, but by and large, if you think de jure control, you're not going to be off, because effectively anything that would be de jure controlled is almost certainly going to be within the modified definition in subsection 112.6. So the rationale for this goes back to this idea that intercorporate dividends are deductible because we're trying to tax corporate income once. If the dividend payer is not a taxable Canadian corporation, and it's also not a taxable, it's also not a corporation resident in Canada that is not exempt from Part 1 tax, then, in all likelihood, Canada has never imposed tax on the underlying corporate income. And so, we don't have to worry about taxing income a second time. When we tax the dividend that's received by the dividend recipient corporation, that's the first time the income is going to be taxed. And so again, it makes sense that we're not going to allow a deduction in that circumstance, because that would just be simply double non-taxation if we did that. And we're not that generous. We might be in the foreign affiliate context, but again, there's actually a tax policy rationale for that we're not going to try to impose tax extraterritorially on business income. So, any questions about section 112 before we move on? Okay, seeing none, we can flip to slide 22. And slide 22, we're going to talk about Part 4 tax. So we talked about Part 4 tax in the concept, in the context of talking about refundable taxes. So eligible refundable dividend tax on hand, non-eligible refundable dividend tax on hand. I mentioned Part 4 tax feeds into those amounts, and I mentioned we were going to come back to it eventually, and now is the moment where we come back to it. It's a couple weeks later than I thought we were going to come back to it, but we're coming back to it right now. So, like we talked about with other with other forms of investment income, and like we actually explicitly talked about with dividend income as well when we talked about the rationale for refundable taxes, allowing intercorporate dividends to be deductible with no test other than the payer is a taxable Canadian corporation creates a pretty significant deferral benefit for high income taxpayers or high wealth taxpayers who can just create an incorporated pocketbook that could receive dividend income and that they're never going to have to touch because they can live off of other means. So instead of holding, like we talked about why this is a deferral opportunity, right? Instead of holding the securities personally in a personally owned brokerage account and receiving dividend income whenever the public corporations pay dividends, they could transfer the shares to a holding corporation. The holding corporation get a subsection 112.1 deduction when the Canadian public corporations pay dividends, and that would be it. There would just be a deferral until the individual extracted money from the corporation in some manner. And again, we're talking about very wealthy people, then they just never are. They're just never going to touch it, right? So I mean, if you're thinking, well, that's whatever, that's kind of who cares about the deferral if it's, Mike Dolson's investment portfolio in his professional corporation that's receiving dividend income. Substitute Mike Dolson for the Thompson family or for Daryl Cates, and you can sort of see how that deferral could become a very big tax loss for both the federal and the provincial governments, right? Like it could be tens of millions of dollars a year that's being deferred by just a single taxpayer as you get higher up the wealth distribution. So not great, right? And it also creates a vertical equity problem where people who are not as wealthy cannot afford to pursue these kind of deferral opportunities. So again, generally speaking, where we have vertical equity problems, that's not cool. And so we need some kind of a mechanism to combat that deferral opportunity. Again, we can talk a little bit about why deferrals are problematic at this point. For those of you with an economics background, you can probably ignore me for the next 2 to 5 minutes while we go through this, because you probably, you're obviously going to be intimately familiar with time value of money. But from the perspective of a government, right, a deferral is not very good, because collecting $100 of tax, let's say, on dividend income today is worth much more than collecting tax on $100 of dividend income 20 years from now. And the inverse is true from the perspective of the person who's earning that dividend income. And 2 reasons for this, right? From the perspective of the shareholder, the deferred amount can be, when you have a deferred tax amount, you have more money to reinvest than you would have if you had to pay the tax immediately. And so you have a larger pool that's going to grow over time, and you'll be far ahead of where you otherwise would have been if you had paid the tax and then just invested what was left. Second, from the perspective of both the shareholder and the government, the effective inflation on a fixed amount is that, I've got to say this $100 of tax has much less purchasing power in 20 years than it does now. And so obviously from the perspective of the shareholder, paying $100 in 20-year future dollars probably has a present value that's functionally close to zero. And from the government, again, also has a present value that's functionally close to zero, but that's a very bad thing, because governments tend to like to spend money now and not the present value of $100 in 20 years. So, given that the present value is functionally zero, this again feeds into the idea that a sufficiently long deferral is tantamount to an exemption. And so if you just have, if you let somebody like the Daryl Cateses or the Thompson families of the world defer tax until the end of time, then they will, and they're not going to care that eventually there's going to be a taxable event, and eventually they're going to have to pay the piper, because it's so far into the future that it's the same thing as just not taxing that income at all. So Part 4 tax is how we, as you probably inferred, Part 4 tax is how we combat this deferral. What Part 4 tax does is it imposes a refundable tax on certain dividends received by a private corporation. And this refundable tax amount gets added to the non-eligible RDTOH or eligible RDTOH of the private corporation. And it gets refunded when the private corporation pays dividends to its shareholders. So the same dividend refund mechanism we talked about a few weeks ago. But the Part 4 tax rate is set at a high enough rate that it's usually worthwhile for the private corporation to flow the dividends through to the shareholders immediately in order to obtain the refund, although this is not always the case. And in fact, in some provinces, it's not worth doing it. But generally, that's the idea. So if we flip to slide 23, we can see how this is done. And turning to the legislation, our main taxing provision is subsection 186(1). So in order for this provision to apply, as we'll see from the preamble of the provision, we have to have a dividend recipient that is either a private corporation or a subject corporation. The term subject corporation is defined in subsection 186(3), and it means a corporation other than a private corporation that is controlled by or for the benefit of a single person or a group of related persons. So for the purpose of this course, we're not going to talk about subject corporations ever again. So you can assume for the purposes of this course that a corporation that's subject to Part 4 tax is a private corporation only. But in practice, do be aware that the scope of Part 4 tax is actually broader than we're going to pretend in this course. Then again, in the preamble of subsection 186(1), you can see that tax is imposed on assessable dividends. Assessable dividends, again, this is a term defined in subsection 186(3). For the purposes of this course, an assessable dividend is a taxable dividend that was deductible under subsection 112(1), which is why we're talking about it in this context. So again, be aware that there's potentially some other assessable dividends out there, but for this course, subsection 112(1) in order to have a deduction and in order to have an assessable dividend. So if we have a private corporation that has received a taxable dividend that's deductible under subsection 112(1), then subsection 186(1) may impose Part 4 tax. And there are two ways that Part 4 tax can apply. First, if the private corporation is not connected with the dividend payer, then paragraph 186(1)(a) imposes Part 4 tax at a rate equal to 38 1/3% of the assessable dividends received from the dividend payer. And so that 38 1/3% gets added to non-eligible RDTOH or eligible RDTOH, depending on whether the dividend was an eligible dividend or a non-eligible dividend. If the dividend payer and the dividend recipient are connected corporations, then paragraph 186(1)(b) applies. And basically the way paragraph 186(1)(b) works is that the Part 4 tax payable by the dividend recipient corporation is going to be based on its pro rata share of the total dividend refund that the dividend payer received as a result of paying taxable dividends in the year. So what I mean, and again, capped at 38 1/3% of the total taxable dividend received. So what I mean by this, and I think we may have some examples that illustrate this concept better, okay, is suppose that we have a private corporation that has, let's say $100,000 of non-eligible RDTOH, and it pays $1 million of taxable dividends in the year. And it doesn't matter to whom and in what order, but it pays $1 million of taxable dividends in the year. And therefore, since $1 million is much more than 2.61 times $100,000, we know that it's going to get a full refund of its RDTOH under subsection 129(1). And let's suppose that our corporate shareholder has received 20% of the dividends that were paid, because it's a connected corporation, which we'll talk about what that means later. but it's a connected corporation. It's received 20% of the dividends and that were paid in the year. So we know that it's going to be subject to Part 4 tax under paragraph 186(1)(b) at a rate equal to the lesser of 38 1/3% of the dividends received, which would be in this case 38 1/3% of $200,000. Or it's going to be subject to tax based on the pro rata the pro rata dividend refund that it effectively caused the dividend payer to receive. And the way that gets done is we just say, okay, well, the dividend refund was $100,000. You received basically 1/5 times $100,000, which is $20,000. Therefore, we're using 1/5 of the dividends multiplied by the $100,000 of dividend refund received. So that's 1/5 times $100,000, which is $20,000. Therefore, the dividend that you have received, corporate dividend recipient that's connected, is equal to the lesser of 38 1/3%, or that $20,000. That's 1/5 times $100,000 of dividend refund received. So that's 186(1)(b). And so generally speaking, it's very good to be connected, because the worst thing that can come from, at least in the context of Part 4 tax, very good to be connected, very important to be connected, because the worst case scenario is that you pay the same amount of Part 4 tax that you would if you weren't connected, and the best case scenario is that you pay zero, because if the dividend payer corporation did not receive a dividend refund in the year, then there's no Part 4 tax, right? Because the formula in paragraph 186(1)(b), the lesser of the two amounts is going to be the amount of the dividend, proportionate amount of the dividend refund, and that proportionate amount is zero, and therefore your Part 4 tax liability is zero. So being connected, excellent result. The amount of Part 4 tax that is going to be paid, and this is the last point on the slide, is reduced by the recipient corporation's losses at the option of the dividend recipient. So under paragraph 186(1)(c), the dividend recipient may designate some of its current year non-capital losses as being applied against the Part 4 tax. And the Part 4 tax will be reduced by 38 1/3% of the losses so designated. Paragraph 186(1)(d) permits the corporation to use any of its otherwise non-deductible non-capital losses, otherwise deductible non-capital losses for any of the 20 preceding years or 3 following years. So again, just like any loss, it's carried forward 20, carried back 3. Against Part 4 tax, and again with the Part 4 tax reduced by 38 1/3% of the amount so designated. So this actually does happen sometimes. It's not super common that people will use their non-capital losses to eliminate Part 4 tax, but it will happen, especially if you haven't refunded your RDTOH and you have a loss carried back where the 3-year carryback period is going to expire and you're tight for cash. You probably would want to carry it back and carry it back designated against the Part 4 tax and receive a refund of the Part 4 tax without having paid a dividend. That will happen in real life. So that is the Part 4 tax mechanism for imposing the tax. And if we flip to slide 24, we can now see how this ties into RDTOH. So on slide 24, just like we did when we talked about refundable taxes before, this ties into the old repealed RDTOH regime just because it's easier to wrap your head around for now while you're trying to figure it out. So again, the amount of the Part 4 tax that gets paid gets added to formerly to RDTOH more generally under the now repealed paragraph 129(3)(b). And because it was added to RDTOH, then it was refundable to the shareholders of the corporation when the corporation paid taxable dividends at the rate of $1 of dividend refund for every $2.61 of dividends paid. And now it's been divided into eligible RDTOH and non-eligible RDTOH. Generally speaking, any Part 4 tax that gets paid on an eligible dividend is going to be added to eligible RDTOH, and any Part 4 tax that gets paid on a non-eligible dividend is going to be added to non-eligible RDTOH. There's one minor exception to that, which is that if a non-eligible dividend causes a refund of eligible RDTOH, which we talked about that a couple of weeks ago, how that might happen, then that RDTOH, that eligible RDTOH that was refunded on a non-eligible dividend may be added to the eligible RDTOH of the dividend recipient, although there's not going to be any GRIP. So that's not a very good situation anyway, because the corporation that receives the dividend still needs to have GRIP in order to pay an eligible dividend to recover its eligible RDTOH. So you really don't want to be going around causing refunds of eligible RDTOH using non-eligible dividends if you can avoid that at all. So that's the basic mechanism. And again, as you've probably figured out, if you've taken a look at 129.1 back when we talked about 129.1 a couple weeks ago, and you've taken a look at subsection 186.1 right now, the Part 4 tax rate and the dividend refund entitlement rate are selected so that they're identical. So that if you have a dividend that's received from a private corporation, if received by a private corporation, rather, from anybody, let's say a non-connected corporation, so you have tax at 38 1/3% under paragraph 186.1a, that you have to pay the exact same amount of dividend to the shareholder of the recipient corporation in order to generate a refund of the Part 4 tax that was paid. So that's the integration mechanism. And we can now flip to slide 25, and we can talk about what it means to be connected. And like I mentioned, being connected is really important because if you're connected with the dividend payer and you're a dividend recipient corporation, then the dividend recipient corporation only has to pay Part 4 tax to the extent that the dividend it received is responsible for a dividend refund being received by the dividend payer corporation. And so again, the result is that if you're tied to the dividend refund that was received by the dividend payer because you're connected, and the dividend payer pays the dividend from its, for example, business profits, and so there's no dividend refund received because there was no investment income, and there's therefore no eligible RDTOH or non-eligible RDTOH, then this just allows for a continued deferral of the corporate business profits when they're received by the dividend recipient corporation. And in contrast, if the corporations are not connected, then it doesn't matter if the payer corporation got a dividend refund or not, or if the payer corporation is paying the dividend from its business income or not, because there's just going to be Part 4 tax equal to 38 1/3% of the dividend received, full stop. So that's the situation in which we find ourselves. And so we want to be connected. And so like it says on the slide, where we look to the definition of connected is subsection 186.4. And subsection 186.4 provides 2 point-in-time tests to determine if a dividend recipient and a dividend payer corporation are connected at the moment that the dividend is paid, which is the relevant point in time that we want to make that determination. So the first way that two corporations can be connected is that the dividend recipient corporation can control the dividend payer corporation. So again, you see control here in paragraph 186.4a, and it doesn't say anything about, you know, directly or indirectly, any manner, whatever. So we know that it's de jure control here. However, just like subsection 112.6, we have a slight modification here in subsection 186.2. And what subsection 186.2 does is it modifies the test for control slightly to provide that the dividend recipient controls the dividend payer not only if it owns more than 50% of the voting shares directly of the dividend payer, but if some combination of the dividend recipient and persons not at arm's length with the dividend recipient own more than 50% of the voting shares of the dividend payer. So the effect of subsection 186.2 modifying paragraph 186.4a is that two corporations that are part of the same related group are generally going to be connected with one another, even where the corporation that's receiving the dividend does not actually have voting control of the dividend payer corporation. So you will have to watch that aggregation, although it's not perfect. There are situations where that will break down. Next, and in a not control situation, paragraph 186.4b provides for a votes and value test that will also create control, or sorry, not control, but will create connectedness. And so what this test requires is that the dividend recipient has to own shares that have effectively more than 10% of the votes attached to all of the shares of the dividend payer corporation. And it has to own shares. They need not be the same shares, but shares that have more than 10% of the combined fair market value of all of the shares of the dividend payer corporation. So this does allow for non-related corporations to be connected and therefore to have the good Part 4 tax result. One of the things you have to be very careful with here, though, and which is a bit of a trap, is that this is not a 10% threshold. It is a more than 10% threshold, right? Which is very important because usually when the Act has a 10% threshold, it's usually an equals or exceeds 10% threshold. But here in Part 4, in paragraph 186.4b, it's a more than 10% threshold. And this trips people up more than you would think. I did have a law school professor who once made the comment, and I think it's probably actually, the longer I've practiced it, the more fair I thought the comment was that if there is a threshold test in legislation where you have to meet a certain percentage threshold for something good or bad to happen to you, it is negligent as a lawyer if you do not open the legislation and double check to see whether it's an equals or exceeds threshold or whether it's a more than threshold. Because just going off of memory has a uncomfortably high chance that you're going to screw up on that. And the downside can be pretty catastrophic, right? If people are, for example, subject to Part 4 tax but they weren't expecting to be, or where it could have been easily avoided, that's a very uncomfortable conversation to be having with a client. So, as just a practice point, is do make sure that you are reading the legislation every time you see a threshold test like this, and that you're very aware that different provisions of the Act use different thresholds, even when they're queuing off the same basic number, which is 10%, which is common. 10% is a common threshold in income tax land, but here in particular, it's more than 10% and not at least 10%. So we have, I think, just enough time that we can start with problem 3 in handout 14. Let's see how this goes. Problem 3 in handout 14, we have two individuals, A and B. They have the same shareholdings of Exco, which is less than 10% of the outstanding shares on a votes and value basis. A receives a dividend of $100 directly from Exco that is paid from Exco's LRIP, so we know it's a non-eligible dividend. B incorporates her shareholdings in Exco, so B's holding corporation also receives a $100 dividend from Exco that is paid from Exco's LRIP. So again, not an eligible dividend. And then it's asking what are the tax consequences for A and what are the tax consequences for B and BCo. So A is relatively easy. We spent the first hour of this lecture today dealing with our individual A. So A receives a dividend of $100 that gets included in income under paragraph 12(1)J and paragraph 82(1)A. Dividend is, like we said, non-eligible. We know that because it's paid from LRIP, meaning we have a non-CCPC that has paid a dividend from LRIP, so not an eligible dividend. The amount gets grossed up under subparagraph 82(1)B1 by 15%, and so we now have $115 of dividend income. We apply our tentative Alberta federal tax rate of 48%, which gets us to Alberta tax of $55.20. Then from this tax, we subtract the federal dividend tax credit under paragraph 121A, which in this case should be $10.38, I believe, and then also subtracted under subparagraph 21C1 of the Alberta Personal Tax Act. We should have, again, I believe it's a $2.51 credit there as well. So at the end of the day, again, $42.31 of personal income tax payable by individual A. So pretty straightforward results, same that we talked about before. Then we have taxpayer B, and taxpayer B is, again, a little bit more complicated. So we start with BCo, and we ask, okay, well, is BCo subject to Part 4 tax? So the dividend is a taxable dividend. BCo is clearly a private corporation because it's just, wholly owned by B. So yeah, we should be subject to Part 4 tax. And we say, okay, well, on what basis are we subject to Part 4 tax? Are we in paragraph 186(1)A or 186(1)B? I guess when we first asked, do we have an assessable dividend? But I mean, pretty clearly we do, because this dividend is going to be a non-eligible dividend, therefore taxable dividend, and therefore deductible under subsection 112(1), because we are just going to make the assumption that this is a taxable Canadian corporation that's paying the dividend. So we're good there. We have an assessable dividend. So the question is 186(1)A or B, which applies? And so then we need to look at whether the corporations are connected. And so we know that if we have less than 10% of the shares of this corporation, it's not a CCPC. We can assume it's a widely held corporation and that there's no individuals related to B in the picture who own more shares. And so as a result, we say, okay, well, they're not connected under the control test. under paragraph 186.1, under paragraph 186.4a as modified by subsection 186.2. And BCo's direct shareholdings of XCo are less than 10% of the votes in value. And so we can therefore pretty safely assume they're not connected under paragraph 186.4b under the votes in value test. Therefore, we know that Part 4 tax should apply at the paragraph 186.1a rate, which is just 38 1/3% of the dividend received, full stop. And so that's going to be the result, is that BCo is going to pay Part 4 tax under paragraph 186.1a of 38 1/3% of the dividend received, which would be $38.33. This is a non-eligible dividend, so that Part 4 tax is going to be added to non-eligible RDTOH under the non-eligible RDTOH definition in subsection in subsection 129.4. And so then what happens is that when BCo pays a dividend of $100, a non-eligible dividend, has to be a non-eligible dividend, to individual B of $100, then BCo is going to receive a dividend refund under subsection 129.1 equal to 38 1/3% of the of the taxable dividend paid up to a maximum of its non-eligible RDTOH, which in this case should cause a refund of the $38.33 of Part 4 tax that was paid by BCo. And then at that point, for individual B, the results are the same as they were for individual A at the point that individual B receives a taxable dividend. So what we can actually see here, and what this, and I know we're like 2 minutes over time, so just bear with me for one more second here. What we can see from this example is that because Alberta is under-integrated on dividends, it is actually better for BCo not to pay a dividend to individual B and not recover the Part 4 tax. By not paying the dividend, BCo defers $3.97 of tax, which is the difference between the Part 4 tax that BCo has paid and the Part 1 tax on the dividend that individual B would pay in order for BCo to recover its dividend refund. This was not the case prior to 2017 in Alberta, and it's not a great situation at all, right? Because in theory, there should be, where we've had now the full distribution by BCo, or at least where BCo is subject to Part 4 tax at the paragraph 186.1a rate, there should be no difference between individual A and individual B. Like individual B should not get this deferral of about 4% by putting the shares into a corporation. It may sound trivial when we're using $100 as an example, but like just add enough zeros behind that number so this becomes relevant to you, right? That there is this 4% deferral at a large enough number is a real arbitrage opportunity, right? And that doesn't make a lot of conceptual sense that it's there. So another example of our integration system being good enough, but nevertheless imperfect. So with that, I'm going to, unless there are questions, again, recognizing that we're over time, but if there are questions, I can deal with them right now. Okay, seeing none, I'm going to stop recording.